Welcome to the Company Value Investor channel. In today's video, we are going to answer a question posed by an individual. And the question comes from Jelani. And the question is this: I was wondering if you could do a video showing the breakdown of the company's financial statements and to analyze the T-Mobile Corporation. Okay, let's analyze the company first, and then after we analyze the company, then we'll go from there. The T-Mobile Corporation. Okay, it takes a little bit for the program to get the current information. Up here is the current information. The current price for the T-Mobile is $56. The ticker symbol is here. The only issue I have is that they're not showing their shares. This is live information, meaning if the stock market is open, it will have the most current information. So the reason why you see NA here is because the NA number of shares is not posted here. Okay, so on the left side we have the financial ratios. Most of the investing gurus use them to analyze companies. I use the financial statements and I changed it up a little bit. What I did is I put the information from the financial statements from the individual companies here. The T-Mobile Corporation in 2017 had a current rate of 7%. There's technically, in order to meet the expectations of both the creditors and owners, they should be making about 14%. What I'm looking for here is that these two different rates are almost alike, meaning they should be either at 13 or 14%. That way I know they're in sync. The second part I'm looking for is the expected amount, and this is the amount of capital the company needs in order to meet the obligations. Basically, this is their performance appraisal. Any positive means that it was an excellent performer. The third item that I look at is the amount made. This is the company's real earnings, not the net income or the net profit. It's the real earnings of the company for that specific year. And the last part that I analyze or I look at is the amount needed. This is the amount of capital that the company needs to make in order to maintain its current operations. Basically, it is their funding. Okay, now let's take the time and analyze the T-Mobile Corporation and find out if it's really a good company for us to invest in. Okay, so the first thing I'm look again is at the rates. Are they almost alike? And if they're not, then that's a problem for me. What I'm looking for is a difference of maybe 1 or 2 percentage points. This is okay. I would rather it be close to 10, 11, 12, 13% here on the current rate of return. The thing that I like about the T-Mobile Corporation is these two sections down here. They made real earnings, even though their net income shows on this side over here, they actually had a positive real earnings, meaning that the company was really profitable. And the fact that they have excess capital in this section tells me that they're able to manage their daily operations and meet all the requirements for, again, daily operations. The only issue I have is the large number here. That is the only reason why the program shows here not profitable, because the number here, the amount expected, surpasses the real earnings. But other than this, it looks pretty decent. Now, in order for us to make a real analysis, we have to go several years to find out if this was just a fluke or a change of styles in management. It could be many different things. Here at the bottom right side, these are the cash flow activities for the 2017 for the T-Mobile company. As we can see, in 2017 they had a total of negative cash flows, meaning they spent most of their money investing. And at the bottom right corner, basically tells me if I spent $10,000 today, These are the number of shares that I would get. And at the end of 1 year, based on this rate of return, I would actually lose $59. So I would have to take that into consideration. But again, what we're doing here is combining current information with prior information and making an assumption based on our analysis. In order for us to do that, we have to go back several years. So let's go back to 2016. Okay, in 2016, again, positive here, negative here, negative here. Okay, in 2016, we have positive cash flows. However, it still shows a large amount of cash flows from investing activities. Maybe that's the reason why you have a negative here. Let's go one more year, 2015. After you do about 2 or 3 years, you should be able to figure out if this is the right company for you based on your needs. Again, they had real earnings, negative here, negative here. So is it a company that I would invest in? No, I wouldn't, only because it doesn't meet my criteria. And my criteria might be different than most of you guys out there. But the fact, what I'm looking for is all green here, positives here, similar amounts here, and hopefully positive here. Okay, all this information is intertwined with the actual company. What I mean by that is when I make a selection for the years, the system or the platform goes back and gathers that information and puts it in this screen here. The next thing that I want to focus on is the first part of the question, is to break down the financial statements. That is a little difficult to do only because it's very detailed and it has a lot of information. When I'm talking about a lot of information, I mean the program. What the program does is it captures live information, it disseminates it, it puts it in this a specific format, and then from there I generate different parts of code to analyze the information and put it the way that I want it to be. For example, I'll give you an example. The current rate is basically the expected return on any risky asset, and the interest rate here is the cost of capital. What the program does, it gathers the information, again, from the financial statements. Remember, the financial statements are three. It's the balance sheet, the income statement, and the cash flow statements. Three different statements. This is all public information. You can get it from anywhere. Initially, I had everything gathered from Google, but when Google restructured their financial pages, they did away with all that, so I had to go back and redo everything that I had before and tailor it to a different format. This information that I gather now, I get it from Yahoo Finance, but you can get it from anywhere. The reason why I do that is because it's convenient, it's easy, it's fast, and it's reliable. So again, this section here, the amount expected, is basically the economic value added. It's a formula that you can, if you Google it or you pick up any financial book, you'll be able to figure it out. Again, all this information comes from the financial statements. The company's real earnings. This is the economic net earnings. This is not the same as the net profit. Very different, but what you want is positive numbers here and positive numbers here. And the last section is the amount needed for basically daily operations. This is nothing more than a pro forma statement. Again, the program in the background does everything for me, and then what it does, it produces the information and puts it out here. The reason why I decided to put the numbers here is for those individuals that are interested in following the numbers. These numbers here on the left corner here, left bottom corner, will or should be the same as the ones from your analysis. Meaning if you gather the information for T-Mobile for 2017, it should be the same. Again, basically what it is uh, the numbers from the three different financial statements, and at the end, the profitability ratios and leverage and liquidity ratios are nothing more but one number divided by another number. I hope that the explanation kind of makes sense. If I was to break everything down into minute details, it would take a long time. Um, but because I took a while to answer this question, what I decided to do is analyze two more companies so that hopefully the individual who asked the question has a better understanding of how I do my analysis and how I choose my companies to invest in. So in 2017, AT&T, this is their current price, current rate, the rate needed, negative here, positive here, negative here. They had negative income here, but the real earnings is here. Okay, it is a weak. The reason why I'm able to see the strength of the stock is because AT&T posted their the number of shares, and this the algorithm that I use or the model that I use takes the number of shares into account to tell me if it's a weak, average, or strong stock. The reason why I have these color-coded sections here is because I can analyze 20, 30 different companies in a matter of minutes just by looking at the color code. It really doesn't do anything, but it's more of a convenience for me to analyze the companies quick, fast, and I can analyze maybe 20, 30 companies in 10, 15 minutes. So the AT&T company in 2017, it shows a weak stock, undervalued stock, and it's not profitable. The reason why it's not profitable, again, is because this amount surpasses this, but they were profitable in the sense that they made real earnings, and that's a good sign. Okay, let's go back a few years, 2016. 2016, the same thing. 2015, again, the same thing. Nothing really changed. So let's go back to the most current year. Now in 2017, although they had positive cash inflows, meaning they made most of their money from operating activities, that shows a good sign. That really shows a good sign. Let's look at the cash flows for, again, positive cash flows in 2016 and negative cash flows in 2017. I think the reason why they have negative cash flows in 2015 was because they invested a lot of money and it finally paid off in 2017. And then AT&T is currently merging with Sprint, so maybe I would keep an eye on AT&T, but right now would I invest in it? No, I wouldn't. And again, if I was to invest $10,000 today in AT&T, I would lose $3 at the end of 1 year. This year is basically a net present value based on this interest rate. Let's do one more, Verizon. Now Verizon currently has a price of $48, and I like Verizon. I think it's a good company. This is what I was talking about. You see how the current rate of return is 10%? Well, they only need to make 8%. So right there, that tells me it's a very good company. Not only it meets our expectations, but it exceeded the expectations. The amount expected is -5, but look at the earnings. The earnings are positive, and the reason why it's a profitable company here is because the real earnings surpass the amount needed for their basically obligations. Even though they show a net income for 2017 of 30 here, they were able to surpass all the obligations when it came to their performance appraisal, which is really good. That's why the stock is undervalued. This is normal to have a negative number. I would rather see a positive number, meaning that the company has excess capital for their daily operations, but 90% of all corporations in the U.S. will have a negative number. The ones that always have or not always, but most of the time have positive numbers are banks and usually corporations that have something to do with money, where they take in income and they run their like mutual funds, not mutual funds, but corporations that that deal with mutual funds, that take in capital. They have a large storage of money, and they'll always have a large positive number here, which kind of distorts the information. But I'm getting off track here. Let's stick to Verizon. Again, in 2017, Verizon had negative cash flows. The reason why is because they spent money on investing and financing, but they had a large amount when it came to operations. If I was to invest $10,000 in Verizon today, a year from now, based on this interest rate, I would earn $173. This 2016, again, average stock, undervalued, profitable. Again, this is the net income. Again, real big, positive, real earnings, good. The amount expected is negative. This is what impresses me about Verizon, the fact that they always, or at least for these last 2 years, they've surpassed the requirements for the interest that they have to earn. And the reason, you can see it right here with the beta is 0.62. Usually a good company has less than 1, and that I think helps them. And the reason why it helps them is because they exceed the expectations. Let's go one more year. 2015 was a better year. Look, they positive number here, positive number. They were very profitable in 2015. Now, would I invest in Verizon? Yes, I would. I have in the past, only because they're a very profitable corporation. They make money. They exceed the expectations. Out of the three companies that we analyzed today, Verizon was by far the best out of the three. It's cheaper than per stock. It is per share of stock. It is cheaper than the T-Mobile, and let's see, AT&T. And well, it's a little more expensive than AT&T, but it is a lot more profitable. What I suggest or recommend to any listener out there is keep your ears and eyes open to focus on AT&T, because they look like they are, once the current rate surpasses or equals this, I think AT&T will be a better, more profitable corporation. But for now, my recommendation, my personal preference would be on Verizon. Although I didn't answer the question of analyzing or breaking down the financial statements, it would take too long, but I was able to provide the information of where the information is gathered, how the information is disseminated here, how accurate, how fast it is. I hope this was able to answer your question. And again, if you have any more questions, please do not hesitate to email me or put them down in the comments. As always, take care and be safe.